your course is accounting in finance as non-finance managers. So this course is important for you to learn. You don't really need to learn as if you're an accountant. But why is it important for you to learn this course, which is non-finance managers? Why should you learn accounting and finance? For you, because you are the manager. So I know that you have a lot of reasons why you should learn this course. But among the main reasons, number one is that it is important for you to learn this course for decision making. So you as a manager, you will need to make decision based on the financial data, whether you should invest in the business, whether you should not invest in the business, whether you should hire more staff, whether you should enter into a new market, or whether you should retrench on a business. So as you study this course, it is important for you to do what? To make decision. So you can decide that, for example, whether to launch a new product if you understand the financial reports, because the financial reports will give you that information for you to either launch a new product, to assess the potential costs. What are the potential costs for this project? What is the expected revenue? You look at what are the profit margin. Is this company operating on profit or loss? I mean, this project, will it operate on profit or loss? So that before you can make any decision, you'll be able to understand. So that is the first reason why this course is important for you. Number one is for decision making process itself. So there are a lot of uh, uh, um, a lot of learning outcomes that you learn as you interpret the financial statements and so forth. You as a manager in practice, you'll be able to make decision. Then number two, it is there for you to understand the business language. So accounting and finance are the language of business. So if you understand them, they will allow you to communicate clearly with finance teams and other departments. So as you understand the business language, as you start this course, for example, as you are discussing, it can be about the marketing campaign with the finance department. So as you are talking about your marketing department with the finance department, you'll be talking about, maybe, are we able to do with the ROI, which is the return on investment, budget allocations, how much should we allocate to the budget towards marketing. The margins will help you to align your strategies effectively. So you might be asked, why is it important to study this course? So you are talking about making decision, business language, to say return on investment, the ROI, for example, budget allocations, the margins that will help you to strategize. Then number three, this course is important for cost management and the recruitment. So for cost management and the recruitment, You as a manager, you need to keep costs under control to maintain profitability and to ensure that resources, including people, are efficiently used. So what we're saying here is that for cost management and the recruitment, you as a manager, you need to keep costs under control to maintain profitability. If you are ordering phones from China, for example, you need to ensure that you put the costs under control so that you are able to maintain profitability. So we will look at a number of things to do BEP, for example, to know how much should you sell in order to break even. As a manager, this information is very important for you. So you need to maintain the costs under control. Not where you have higher costs. The other time we were doing ratios. So you're able to tell. So for example, if you're hiring new employees, you need to estimate what are the costs associated with employing new employees. How much is the salary? How much is the training? The benefits? So you compare with the potential revenue to ensure that you make sound decision. You don't just employ anyhow. So you need to maintain the cost management in the recruitment. So as you study this course, it will help you to understand. Then the other reason why is that sourcing, finance, and investment. This sourcing, finance, and the investment. So on sourcing, finance, and investment, every business needs funds to grow. So as you are dealing with this course, you'll be able to understand how to source finance. It can be through loans, it can be equity, it can be retained earnings. So we will discuss all these, which are very important for expansion in the business. So for example, if your company wants to expand, you need to decide whether to take a loan, whether you need to issue more shares, whether you need to reinvest the profits that you make in a business. So it will help you to assess the best options. Sometimes you might even be asked to say what are the sources of finance. So it's important that you need to understand every business needs what? Funds to grow. And where do we get those funds? So as you study this course, you'll be able to understand where to get the funds and all those things. Then the other thing is financial statements. So financial statements in the risk management. So on financial statements and risk management, so this course is important because it will help you to understand the financial statements, like the income statement, the balance sheet, the cash flow statements, which will give you insights into the health of the business. So if you understand these, they will help you even to assess risks. What are the risks associated with a business so that you can even make informed decisions. So if you can review the balance sheet, you can see if your company has too much debt, so that you can even strategize to see how you can pay back that debt. Or if you do not have enough cash, so it will help you avoid the risks, decision that can even hurt the business in the future. The other thing is, why is it important? You will be able to know recording transactions. So in recording transaction, it will help you to keep accurate of record of every transaction, which is important for accountability, audit, and making good decisions. Not where someone just tells you on the phone, your boss calls you, says, no, can you send me 5,000? And you send. But there's need for recording so that you are able to audit. And someone should be able to sign that, no, they said that I should send money. They should be formal way of doing things in companies. Why is it important also is that it will also help you for financial planning. So financial planning is about creating a roadmap for your company's financial future. So it will help you to set up budgets. You can even forecast the revenues, and you can even plan for growth. You're able to say, in this month, we'll be able to sell. In the next 3 months, even a year, we'll be able to sell this based on the trends. So you can have financial planning. You can forecast the revenues. To say this month we might have growth in the revenues, this month we will have losses. So you can forecast. You can know to say we can invest in this business, we cannot invest in this business. So for example, if you are planning for a marketing campaign, you need to know how much money you need to allocate for advertising, social media. If you are boosting, how much should you boost for the page, the salaries, the other costs. So it will help your business. Financial planning will help your business that you do not overspend. It will also help you to form performance measurements in the KPIs, which are the key performance indicators. So it will help you measure the business success, even how the key performance indicators within departments. You will know how to set and track the KPIs to ensure that your team is working towards right objectives. So if you're running a restaurant, for example, so the KPIs might be, what is the average customer satisfaction in school? So you're checking on those things so that it can help you to make decisions, so that you can even improve the operations where you are operating. So those are some of the reasons why it is important to learn this course. So this course has the main branches. So the main branches, if you have any question or if I'm fast, you can let me know, or any clarity. So we have about 3 main branches of this course. So the first branch is financial management. So financial management, the focus for financial management is that it focuses on long-term financial decision in order to increase the company's value. So the first branch is financial management. So financial management focuses on long-term financial decision making in order to increase the company value. So the purpose is to ensure that decisions made today they will benefit the future of the company's growth and sustainability. That is the first branch. So the first branch in this course is that it looks at financial management, which focuses on the long-term decision-making process. So the purpose is that the decision that you make today will benefit in the future of your firm, even its sustainability. So for example, a company can decide to invest in a new technology today. So you say, let's see, invest in a new technology that will improve production efficiency over the next 5 years. Or you might decide whether to expand into international markets based on the projected long-term profits and risks. So it's a long-term project which might last for 5 years, 10 years, 20 years, and so forth. So that is the first branch, financial management. Then the second branch is management accounting. So management accounting, this one focuses on the short-term decision to implement long-term strategy and control business operations. So for you to achieve the long-term financial management, you have to have the management accounting. So the management accounting looks at short-term decisions in order to implement the long-term strategy and control business operations. So the purpose for management accounting is that you want to track the performance and you make an adjustment to real time to achieve business goals. So you break the long-term objectives into the short-term objectives in order to meet those long-term objectives. So for example, in management accounting here, you're looking at maybe you set up a monthly budget for marketing department. So you're comparing to the actual spending planned budget for the long term. So you're saying, okay, let's have in each month, how much are we going to spend on budgeting? Oh, okay, we will be boosting our page 300 per month or 150 per month on Facebook. Or monitoring daily sales. You say, how much are we? How many sales are we making in a day? That will align with the monthly target. So you're saying how many are we supposed to sell in a day? So you're looking at, okay, if we sell 3 today, even tomorrow we sell 3, so how much are we going to sell for the entire month? So you are taking those corrective actions in order to ensure that you meet the more target. Or maybe you are preparing weekly reports to track production costs and productivity to ensure that you meet the goals. So you are checking. Say, are we meeting our weekly? So you have weekly reports. So you are tracking to check whether what you had planned, you are in line with what you are doing. That. Then the third branch is the financial accounting. So on the financial accounting, here you are focusing on reporting. So here the focus is on reporting. So here you are reporting the company's performance to the external stakeholders. So financial accounting, you are reporting to the external stakeholders. So the people that are affected by your decisions. It can be the shareholders, the owners of the company, it can be the banks, it can be the regulators. So you are reporting. So here the purpose, you want to provide the accurate picture of the company's financial health and how well it's performing or how bad the company is performing. So you are reporting. So that is the third branch here. So on the third branch here, on the financial accounting, for example, we're talking about you preparing the income statement. So the income statement will show you the profit and loss statement. So how much the company earned, spent, and so forth. Or you're preparing or generating the balance sheet. So you're showing what are the assets, liabilities. So we'll look at all these things. Or you are creating the cash flow statement. So you are showing how the cash flow, how the cash is flowing in and out of the business. So those are the three branches. So there's a difference between these three, which you need to know, which is also very important. So the first difference can be seen in, so allow me to write the word here, differences. So these differences can be seen in number one, reporting interval. So on the reporting interval, we have number one, we have financial accounting. So these are the differences. So when we're talking about financial accounting here, when it comes to the reporting interval, so when you're doing the reporting here on the financial accounting, you make the reports are usually produced annually. So though business may produce them half yearly or quarterly, here you are saying that reports are done what? Annually. So a company will release its annual financial report in January, as an example, showing the performance from the previous year. So you will have as at, or it can be in December, as an example. So you are reporting annually when you're dealing with the financial accounting. So reports are done what? Annual. That is a key term, because this one is a long term. Although some businesses may produce them half year or quarterly, but they are done in an annual aspect. But when it comes to management accounting, so management accounting reports can be produced as often as needed. It can be weekly, it can be monthly, it can even be daily. So a manager can receive monthly reports on a company's expenses, sales, performance to help making decision. The CEO or the manager can be looking at day-to-day activities to say, what have we done today? Give me a report of what you've sold today. Or today we've only sold 10 phones. Today we've done what, and all those things. So it can be weekly, it can be monthly. That is management accounting. Then number 2, these can be seen in terms in time horizon. So in time horizon, the difference is that with financial accounting, it focuses on the past performance. So it is backward looking. So reports on what happened. So you are reporting on the past performance when you're dealing with time horizon. For example, you can give reports showing how much profits the company made last year, or how much losses the company made in the previous year. But when it comes to management accounting under time horizon, here you focus on both past performance and future forecasts. You see that? So you are giving both past and future forecasts. So you are providing insights for the future decision process. For example, a report that not only reviews last quarter's performance but also includes prediction and plans for the next quarter or for the next month. You are making what? Plans and predictions for the next month, next quarter, and so forth. Then the other difference, it can be on the range and the quality of information. So on the range and quality of information, so here when it comes to financial accounting, it mainly focuses on financial data that can be quantified, something that you can calculate, like quantity. You're talking about numbers. So it will look at issues to do with quantity, something that you can quantify. It is something like it look at revenue, profits, expenses. So for example, here you're talking about issues to do maybe with a balance sheet. So you list the total assets, the liabilities, the equity, and so forth. So when it comes to the range and quality of information, when you're dealing with financial accounting, you're talking about numbers. How much was the revenue? How much is the profit? What are the expenses, and so forth. But when you're talking about management accounting here, you're talking about it includes both financial and non-financial data. So you can talk about quantities of a product, how big is the product, what is in the product, or units produced. How many units did you produce? So the reports here will not only show the sales figures, but also the number of units produced. So it includes both quantities, units, and non-sales items. Then number 4, the differences can be looked at in terms of nature of reports produced. So on the nature of reports produced, when it comes to financial accounting, on the nature of reports produced, so financial accounting here, reports are general purpose and designed for the wider audience. So the nature of reports here, they are general purpose. You're giving the wider audience. It can be the investors, the creditors, the regulators. So it even includes the external users of financial reports. So here, for example, a financial statement, maybe you intend to show the company's financial health to the potential investors. You're saying people can invest. So let's see, give them this financial report, or maybe the banks. But when it comes to management accounting, reports are tailored to specific decisions. You are tailor them to specific individual decisions. Often it can be individual managers or team leaders or teams. Just that's why you're taking that information. For example, you're giving a report to the sales manager within the company showing a detailed information on the sales, the sales achievements, maybe the targets, and you're even showing the areas of what improvement. Then when it comes to the level of detail, so when it comes to the level of detail, when it comes to finance here, which I'll put number 1, finance accounting, you are giving a broader overview of the company's financial position and performance for a specific period. You're giving a broader overview. So for example, maybe you give a simple summary of the company's total profits, revenues, and the expenses over the year. But when it comes to management accounting, on the level of detail here, you are providing a detailed and specific information to help managers make operational decisions within the company. So it can be a monthly detailed cost analysis to help the manager to decide whether to continue or cut certain business activities within that period. So when it comes to regulatory, number 6.
I think please repeat the level of detail for me.
So the level of detail, when it comes to financial accounting, you are giving a broader overview of a company's financial position. So you are giving how is the financial position of a company and performance for a specific period. It can be a year, quarter, and so forth. So you are giving a company's total profits. You can even give a summary of how much was the total profit that you made the entire year, how much was the revenue the entire year, how much were the expenses for that year. So that is a level of detail. You go in depth to show an overview of the company's position. But when it comes to management accounting, when it comes to the level of detail, you are just giving, you are providing detail and specific information to help the managers make operational decisions in that segment. So for example, you can give a monthly cost analysis, which will help the manager decide whether to continue or they should cut certain business activities in that month based on how we've been operating. Say, here we haven't been doing much compared to these other products. Maybe let's focus more on these other products. These other products let's cut this month because people are focusing on these products. Then when it comes to regulations, financial accounting, regulations, when it comes to financial accounting, you are subjected to strict external regulations. So you must report based on the standardized accounting principles. So a company must follow a legal accounting rule. Failure to follow those accounting rules, you might face a lot of repercussions. So maybe a company must follow a legal accounting rules when reporting to governments, investors, and so forth. But when it comes to management accounting, you're not subjected to external regulations. Yeah, there might be other structures, but you're not subjected to external regulations because the reports they are for internal use. They are only for the company, for them to use. It's for the business needs. So maybe a company can create a custom report for internal purposes. Like maybe you want to track employee productivity, you want to see how workers are being productive without worrying about external regulations. So, hope those are clear.
Yes, they are.
Then the other thing that we needed to look at is accounting and finance. So accounting, if we define accounting, we're saying accounting involves collecting, analyze.
Sorry, just a minute. On regulations, we talked of the finance, accounting. The other one, I didn't get that other one. The second one,
Management accounting. I said
Yes.
I said on management accounting, you are not subjected to external regulations. When it comes to regulations, you are not subjected to the external because reports they are for internal use, they are for workers within the company. So you are making them in a way that they tailor to the business needs. So maybe you can create a custom report for internal purposes. Maybe you want to track employee productivity so that you see how productive your employees are without worrying on the external regulations. So now I was saying that we needed to define also what is accounting in finance for this course. So accounting is or involves collecting, analyzing, and communicating financial information to help business make decisions. So accounting, in other words, you should be able to collect the data. After you collect that data, you analyze that data. Then after you analyze the data, and then you communicate that data in order to help business to make decisions. So the purpose for this accounting is that you should be able to give information that will help the decision maker and the controllers. These can be managers, investors, to make a decision in the company. So accounting, for example, if you want to help, it will help you. For example, if you want to come up with a new product or service, you say, okay, let's come up with a new product or let's come up with a new service. So a company will use reports to decide if it can afford to develop a new product based on the current profits and costs within a company. So accounting will help that. It will help adjust prices or quantities as another example. So if a manager review costs and sales data, they will decide if it's profitable to lower the price. Because our competitors have lowered the price, is it profitable of us to lower the price of a product? Or maybe should we produce more units of this product? Accounting also will help you on the issue of borrowing money. For example, a business, it will use its financial statements whether to decide, can we afford to take this loan and expand the operations of a business? Or maybe this business has been operating on loss, no need to expand. So you are collecting, analyzing, and communicating. So you collect the data. Should we increase the capacity or maybe should we decrease the capacity of a company? So a manager will analyze the data, you collect the data, analyze the data to determine whether you can afford to increase the production, expand the businesses. So it will help you to check. You're collecting the data, analyzing the data, and you're communicating that data. Should we change production or distribute models? So accounting data will help you to assess whether it would be cost effective to change the suppliers. Let's now go to the new suppliers. Let's leave these other suppliers and go to the new suppliers. Or maybe should we adopt to the new technology? Should we start e-learning or should we just maintain with the physical learning? Should we adopt to the new technologies? Are we going to lose money? Are we going to make money? So you are collecting the data, analyzing the data, and you communicate that data. So you are communicating to say, okay, we can invest, we cannot invest. We can adopt, we cannot adopt. We can borrow, we cannot borrow. We can develop this, or no, we can not develop this. We can produce this, we cannot. So you are collecting the data, you analyze the data, then you communicate what decision do we make after collecting this data. Then when it comes to finance, on the other hand, finance is about a business raises and invests money to support its operation and growth. So finance is about how a business rises and invests money to support its operation and growth. So it is important that business should raise funds in a way that aligns with their business needs and goals. So finance, it looks at how business raises money and invests money. And this money that they raise and invest, they should be able to align with the needs of a business and the goals of a business. So for example, what you need to understand about this is that the main forms of finance. So business can raise funds through loans, it can be debt, they can issue shares, which is equity, Or they can say, let's just reinvest the profits that we had made. Those are internal finance. So it can be debt, you get loans, you can issue shares, those are equity. Or you can reinvest, the business makes money, you reinvest that money again. So to understand finance, you also look at what is the cost and benefits of finance. For example, you're saying a loan might have lower immediate costs, but they come with interest and risks. But if you just give out shares or issue out shares, you might dilute ownership. Other people will own the company, but it doesn't require repayment. So you look at what is the cost. Should we get a loan or should we allow people to invest in our business? So with finance also, you need to look at what are the risks associated with each finance. So what are the risks? Loan, for example, it will increase financial risks due to the obligations that you need to pay. But relying on equity, also you give others. So you also need to look at what is the role of financial markets in supplying finance. So like financial markets, the stock market, which provides business access to larger amounts of capital by selling shares to investors. So you need to evaluate the investment. How much are we going to get from this investment? What are the risks associated with this investment before you can do anything? So that was about accounting and finance and the importance for this course.